Let's talk about tokenization. What the internet did to fintech like 10, 15 years ago, blockchain is going to like 10x it in terms of financial innovation in the next 5 years. This is basically, as I was telling you, this is the bleeding edge of financial innovation that we are discussing. Nobody else is talking about it anywhere other than the US, and even then, this is a very obscure niche
It's not
topic.
yet mainstream.
Oh yeah, not mainstream at all. This is basically what the finance nerds and the crypto nerds are talking about in their podcast, just like we are doing here. So let's basically start by exploring the idea of what tokenization is and why does it matter. So we started this series of podcast episodes, or just basically standalone videos that we are doing. We started out covering stablecoins, and stablecoin is obviously a fascinating topic, but stablecoin is just one arm of the entire tokenization movement that is happening right now. So stablecoin basically means it's tokenizing the US dollar, or it's tokenizing any currency, putting it on the blockchain and giving it a one-to-one pegged value of that currency that you can transact on the blockchain, right? And it has myriads of values, like why it's important. So, and we have obviously gone through every single one of them in the last two episodes, and we will continue covering stablecoins in the future as well. But in this episode, we will specifically discuss tokenization and what it exactly means. So, remember when we were discussing the Genius Act in the last episode,
Mhm.
I said that one of the criticisms that it was facing was regarding how stablecoins under the Genius Act were not allowed to offer you yield, any interest,
They
any
almost act like banks.
yeah, exactly. So basically, the Genius Act didn't does not allow you to offer any yield to your investors. And I said I am okay with that because stablecoin is a standalone currency, and a currency should not be yield generating by itself.
Mhm.
But there are other ways, other avenues through what you can basically get your yields from, and that's what tokenization talks about. Tokenization solves this problem by essentially tokenizing anything, any traditional finance instrument that we have. You can basically tokenize it, put it on the blockchain, and voila, you have something that you can invest that you previously had to invest through conventional means. Like,
Mhm.
in the very beginning, everything was just a piece of paper and something written on it with a seal of a stamp from some authorities or the other. Like, for example, like before the internet, stock exchanges issued like physical papers
Yeah.
or stock certificates that if you owned like a certain number of papers, then you can basically redeem it, sell it, maybe even do some sort of transactions with it. And all of this were specifically done on paper. And then the internet came, and then all of a sudden, now you can trade stocks directly on your little app that you have on your phone. It's just like that. But still, stock exchanges work 9 to 5, 10 to 6.
Mhm.
That's basically just 8 hours of the day. But the rest of the 16 hours, stock markets are asleep. The general macroeconomics market that functions across the globe, everything is asleep for 16 hours a day. And then there is time zone differences. So, for example, the London Stock Exchange and the New York Stock Exchange has a time zone difference of like 6 hours or something like that. So you cannot do real-time transactions in these odd hours, even if your stock exchange is live and theirs is not simply. But tokenization and essentially blockchain fixes this issue, but
It
because
also
blockchain
lowers
is
the bar for which people need to get into to own something, rather than where previously people need to pay big amounts of money. Tokenization lowers the bar for it.
yeah, exactly. And what you're talking about is fractionalization of assets, of tokenized asset. We'll get to that like in the next 5 to 10 minutes. But let me actually give you some context on how blockchains actually function. Because we have spoken about stablecoins quite extensively, but we haven't really discussed the fundamentals of how a stablecoin is actually performing, how these transactions are actually done, which is like the entire premise of tokenization is based on a functioning blockchain. And all of this is happening because we have mastered blockchain technology and found something that solves all of these blockers that we previously had. So let's break down what a blockchain really is. Uh, in simple terms, a blockchain is a distributed ledger A ledger is where you keep records of transactions, right? Every single business has some sort of a ledger that they operate to do their taxes, to do their maintain their accounts and stuff like that. But what's fun about blockchain is it's a distributed ledger. That means anyone with a valid system, or basically what we call a node, can access and suggest changes to the blockchain, approve transactions to the in a blockchain, and basically manage it without ever contacting or relying on a centralized authority. So, like, I'll just give you an example of what the Bitcoin blockchain does. Which is Bitcoin blockchain is the OG blockchain. Before Bitcoin, there were no blockchain. Today, we have thousands and thousands of blockchains, but Bitcoin is the strongest one we have so far. So, what the Bitcoin blockchain does is essentially we are two people who are transacting some amount of Bitcoin through a blockchain. So what we'll do is every single wallet holders, every single addresses are listed on the blockchain. And if you make a transaction, let's say if you propose a transaction, the people who run the Bitcoin nodes, and the Bitcoin nodes mean basically the node is a piece of software that you have downloaded from the Bitcoin website, and then once you have downloaded it, you can essentially become a part of the people who run the Bitcoin blockchain. Now, and depending on how much GPU or compute power your computer has, the higher you rank in terms of your power and authority in that network, essentially. So when I'm proposing a transaction to you, you basically, let's say I'm sending you 5 bitcoins. So what any node runners will do is basically first verify that I have 5 bitcoins in my account, and then verify that I'm sending, and basically approve that if I have it, the transaction goes through. And for that, they get basically a percentage, like it's called a transaction fee or gas fee. They charge it, they earn that, and basically the transaction goes through. What happens in this case is someone at some point is always online to do these verifications. So when enough people approve a single transaction, let's say with vast majority saying yes, this transaction is valid, this goes through. So there is no centralized need for an absolute authority who says, okay, this transaction goes through, this transaction is rejected. And this is the primary issue that a blockchain solves, is that you do not need a single point of failure. You do not have to attack. If you attack like an Amazon server or a Meta server, and at a massive enough level, you can essentially cripple their infrastructure with a single what they call like denial of service attacks, like the DDoS attacks that they do. Like sometimes you will hear that WhatsApp is not working, Twitter is not working. Most of the times this is the kind of attack that they are facing, and a blockchain is essentially immune to that, because you cannot target a single node and say like everything cripples, like if you can attack that node, because there are
It's not
thousands and
necessarily
thousands of
their
nodes.
approval, is it?
Yeah, not only their approval, there is just like you have to, like, this is called a 51% attack. Like you have to compromise 51% of all nodes working on the Bitcoin blockchain, and you cannot do that because you cannot like remotely you cannot remotely access and compromise thousands of nodes at the same time. That's not possible. Yeah. So this is the primary issue. Like for example, like the Bitcoin blockchain is unhackable because of that. Like if you can hack the Bitcoin blockchain, your reward is $2 trillion worth of Bitcoin in that blockchain, right? So this is the biggest bounty ever. But nobody has ever able to do it because this is just so decentralized. This is distributed beyond you can imagine, and that's because what a blockchain does and why it makes it possible to move trillions of dollars worth of money seamlessly and instantly, because you don't need any third party centralized authorities to approve anything. And the moment you need centralized authorities to approve stuff, then comes like this is now it's just based on human capacity, and a human needs to sleep for 8 hours, he has to do other stuff for 8 hours, and he's only available for 8 hours out of the 24. And then, as I said, the time zone issues, and also it's because some of the transactions are simply not approvable, because let's say 5 different authorities need to approve one transaction, and they will do it like each of them will take 24-hour times. So that means one transaction requires 5 days to do it, whereas on blockchain it's instant. Nobody is basically a bunch of anonymous node runners are approving your blockchain, approving your transaction, and that's it. Yeah, so that's basically an introduction to blockchain. Now let's get into what is tokenization. Tokenization is, do you know what an ETF is?
Mm-hmm.
So
Think I have very
basically,
basic idea about ETFs.
yeah, okay. So what you are doing with an ETF is, let's say you want the Mag 7 stocks. The Mag 7 stocks are like Apple, Tesla.
Amazon, all of that.
Yeah, exactly. These are the like Mag 7. Now you want one unit. You basically want them, all of them in a single bucket, and you want to invest in them.
Mm-hmm.
So you have two options. You can either do like a mutual fund or you can do like an ETF. A mutual fund is basically you are buying a little bit of all of those, and that's a mutual fund. Now an ETF will be ETF is like a standalone asset that is backed by the target, like those Max 7 assets. Like I will give you an even simpler example, like gold. Like you can buy a gold, like if I am issuing gold ETFs, then that means that I have physical gold in my storage, and against that gold I am issuing an ETF that is basically a version of paper gold. So like if I let's say I have, hypothetically I have 5 tons of gold in my reserve assets, and based on that I am issuing like the 5 tons equivalent of gold ETFs. You can buy, let's say, 10 grams of it from me, and if you buy it, that means basically from my reserve that 10 grams is blocked in your name.
Right.
And when you want to sell it, you sell it. What happens is basically I don't have to, like, as a buyer, I as a retail investor, I don't have to deal with physical gold. Someone else is taking care of that for me. I'm just dealing with the paper, and as the issuer has to deal with storing the gold, making sure everything is safe, insurance, and all of that stuff.
Mm-hmm.
And as the investor, I just care about the paper certificate that says I own this amount of gold from this issuer, and just an ETF. Like even today, like last year, the first Bitcoin ETF got approved. A Bitcoin ETF, what a Bitcoin ETF is basically the issuer company owns a bunch of Bitcoin, and against that Bitcoin, they're issuing paper Bitcoins.
Okay.
And then you can trade those paper Bitcoins. Now, why would you do that?
That is tokenization, is it?
Yes, that is the essence of tokenization.
Okay.
But it's tokenization in reverse, because both, like if you were to trade the physical gold, you are doing it basically through traditional systems. Even if you are to trade the ETFs, you are doing that through traditional systems as well. But tokenization lets you do it through blockchain.
Okay.
Yeah. So what that means is, like, you can have a tokenized gold on the blockchain, like Pax does it. But Paxos does it. Paxos is this company that issues tokenized gold that you can buy and sell. What that means is the concept of ETF in terms of the reserve asset remains the same. Like you have a reserve of assets, and then against that you are issuing these tokenized pieces. Essentially that means like you don't have to deal with the entire reserve asset. You are only dealing with what you have in terms of the token value of the asset itself. I'll give you another example. Let's say you want to trade US treasuries on the blockchain
Mm-hmm.
instead of you going through the conventional methods, because the promise of blockchain is, as I said, it's incredibly fast. It's always on. It's very very secure, and you get access to a bunch of new kind of assets through the blockchain that you wouldn't have otherwise got if you are using conventional methods. So yeah, that's basically why you want to use why you want to tokenize all of these assets. So I will just what I will do, I will show you a survey that Ernst and Young's and Coinbase conducted together earlier this year in January, and they basically interviewed, asked a bunch of questions to asset like institutional investors. Like can you see the screen?
Yep.
Yeah, so basically here you can say like they conducted a survey of 352 institutional investors, and they asked them their thoughts on tokenization, on digital assets, on stable coins, stuff like that. So for example, in this section here, they found that 84% of institutions are either already utilizing or expressing interest in utilizing stable coins. driven predominantly by goals of portfolio diversification. 76% of firms intend to invest in some form of tokenized assets by 2026. What this means is, so far, crypto was a fringe asset category. You are no serious traditional investors would look at crypto seriously. They wouldn't have looked at crypto like this in 2020 or 2022, for example. But right now, traditional investors, institutional investors have understood that blockchain is truly a game changer in terms of how easy it makes it makes activities like trading, foreign exchange, and stuff like that. So I will also show. Let me show you another thing here. Like almost half of respondents leverage stablecoins, with the key use cases focused on yield generation, transactional convenience, and in the markets and foreign exchange. So as you can see here,
All right, Romeo, before we continue, is yield generation the reason why the Genius Act was kind of blocking stablecoins? Like not
uh,
allowing to.
yeah, so basically they did not want stable coins to be yield generative. So because the primary issues of a current of holding a currency that gives you yield by itself is like that it ceases to be a
almost acts
currency.
like a almost acts like a bank, right?
Yeah, it not bank. It almost like the currency itself starts acting like an asset. Like for example, I send you 10 USDC,
Mhm.
and you have held it for like let's say 15 days, and you get 10.5 USDC in yields. Like now imagine some asset manager or like a company that pays out $10 billion of salaries every year.
Mhm.
They have their salaries, they have their salary accounts all in stable coins. Now what happens is that whenever these salaries are going out, it's suddenly the amounts are increasing because the
There's
stable
yield.
coins in general are yield generative. Then the calculation gets messed up. And
Ah,
in the event of, let's say, someone is taking out a loan of $10 billion in a stable coin, and then the loan itself, the amount itself is
yield.
generating yields. Like it gets like super complicated in a hurry, and it doesn't really solve anything, because if you want yield, there are all of these other instruments that you have. Why would you want your stablecoin to be yield generative? you know
I see.
that's number one. And even if you want yields out of stable coins, you could do some sort of like, there's this concept of staking, where you go to a protocol or you go to a company and you say like, okay, I'm giving you 10,000 USDC for 6 months. It's like a bank fixed deposit, and you give me a 5% interest on this. You can do that like that, but the stable coin itself should not be generating any yields. That's the point here.
And since we are at staking, I came across this term called yield farming. And can you explain what is that?
Yield farming is basically, um, yield is interest. So whatever activity generates interest out of the funds that you have already got is yield farming. So like staking is one of them, where you have some amount of Bitcoin or some amount of Ethereum. You go to a crypto protocol, or you go to a crypto project. You lock your assets for a set amount of period, and you earn an interest on that. That's basically it. You are providing liquidity, and in return, they are giving you an interest. Like if you go to a bank and give them your money and lock it for a year, they give you like 7% interest, right? So that's also a form of yield farming. So anything that generates yield is in yield farming.
Got you.
Yeah. Okay. So now moving on with this survey, another interesting point that I found here is like, 57% of surveyed respondents are interested in investing in tokenized assets, particularly alternative funds, to drive portfolio diversification. So it's pretty much established that in the institutional investors are extremely, extremely interested in this stuff. So I mean, I'll show you a few more things. Let me find where it is. It's a very interesting document. I will leave the link to it in the description, so anyone who is listening to it can go through as well. This is done by Ernst and Young's. Yeah, look at it here. Like more than half of respondents are interested in investing tokenized assets. So why do they want to do it? Like 65% says portfolio diversification. Portfolio diversification is basically means you want to invest in a bunch of other things at the same time to hedge your risks, hedge your bets, make sure when one side of the market is going down, the other side keeps you afloat. Fractionalization, I will go through fractionalization in a moment. As I was saying, like
Instant
faster
transfer.
trading and near instant settlements. This is when you're using blockchain, it's a given.
Instant.
um, Access to new asset types and another is greater liquidity. Liquidity is like whenever you want to sell something, you can sell it instantly. That's liquidity. So that you don't have to find a buyer. There are already so many buyers lurking around that you just say
Ah,
that I'm selling it and it gets sold. That's what liquidity is. Like, for example, I'll give you an example of an illiquid asset. Let's say you own a piece of artwork by and not even Leonardo da Vinci. Let's say someone slightly less known, like Monet or Basquiat. They're obviously one of the greatest artists of all time. But let's say you own one of their paintings, which is priced around $100,000. To find a buyer, you cannot just all of a sudden like post on tell people that I'm selling it and you instantly find a buyer. That's not happening. You have to either go through an auction house, gallery, museums don't sell, but something like this where a lot of art experts are roaming around. You tell them like I want to sell it. At some point, the thing gets sold. But if you are selling Apple stocks, if you are selling Amazon stocks, you just press sell and it's sold instantly. That's basically what a great liquidity means. So you always want assets with great liquidity. You don't want to trade in illiquid stuff. So yeah, another piece of information that I found very interesting is like who are interested in investing in tokenized assets. 72% plans to invest in 2026 with alternative funds and commodities. Commodities will be your gold, your oil,
I see.
even like agricultural products. Like rice,
Is
wheat,
it?
pork, barley, stuff like that. And then you have private equity, private credit, real estate, and then what else? What else? Like bonds. Bonds, as I had previously explained, like bonds is it's a United States Treasury, um, and then there's money market funds. It's similar to treasuries, but it's not treasury. It's a very low risk asset. I will explain what that is, let's say in a later episode. That's actually a very interesting and at the same time very boring topic. Money market funds and how they operate. Like if you don't want your investment, if you don't want to invest in a risky market, if you don't want to invest in a volatile market, you park your cash in like money market funds and US treasuries and stuff like that. These are extremely low risk, extremely low volatility markets. Yeah. So here's another thing that I found really interesting, which is like why are they interested exactly? Like why do they want to invest in tokenized funds?
Mm-hmm.
Again, like instant settlement,
Yep.
increased liquidity, ability to offer fractional ownership, immutability and transparency of data. So this
What's
is immutability means like you cannot change the record once it's there. Like you cannot change a blockchain record. It's not like if you want to change the record in a blockchain, you have to have 51% consensus. Like
uh,
uh, it's a very democratized process. Like so basically once one transaction is recorded, it's always there. You can like it's nearly impossible to change it. Like in the history of Ethereum, there has only ever been once that the blockchain record has been reversed or or a transaction has been omitted, and that was because there was a massive hack in Ethereum back in 2017. So they had to reverse the block by they had to reverse the block transaction process to basically recover from the hack. Maybe we'll talk about it some other time. The Bitcoin blockchain has never been hacked, so it's immutable. The data is available to everyone. Yeah, so these are the primary reasons why
and
people are so interested in this.
the transparency of data and gaining go up a bit. Yeah, the transparency of data and gaining ownership visibility.
Yes and no. Yeah, basically ownership visibility is
Am I right in thinking
transparent
that?
data. Yeah. Yeah, so I will explain like what transparency of data actually means. So like you have a bank account number, right?
Yeah.
So if you have a wallet address, like a crypto wallet, you will have a wallet address, right? And with that, if I have that wallet address, I can simply go to a blockchain explorer and put your wallet address there, and I will be able to see everything that you hold in that wallet, and every single transaction that you have ever made since the inception of that wallet. And
And
what
why is that a feature? Isn't it like very intrusive?
Yeah, exactly. It's very intrusive. So it's up to you to keep your wallet address hidden. Like never expose it to anyone, or maybe keep a private wallet address that no one knows, and then transact with public email, public wallet addresses. But at the end of the day, like if I know your wallet address, it's very easy for me to track your financial habits. But since the wallet address is never linked to your actual identity, if I don't know who you are personally, then I have no idea whose account I'm looking at. So it's extremely transparent. If you're like very fearful of privacy in the blockchain, then you can use private blockchains. Like there are a bunch of private blockchains where none of this data is actually visible. So you can do any sorts of transactions, and all of these transactions will be hidden if you're using a private blockchain. But private blockchains are quite rare. Like one of the biggest private blockchain is Monero. I think there is another one called Onyx that is coming up. So yeah, it's actually pretty interesting stuff. We'll get into like the privacy side of this of the argument in much more in depth in a later episode.
And before we move forward, can you tell me the difference between like what what makes tokenization different from like stable coins? Because that is something I'm yet still confused about.
Yeah, sure. So basically, a stablecoin is a tokenized asset. What the difference between a stablecoin, like whenever we are speaking about any tokenized asset, the easiest definition is that this asset lives on the blockchain. That's all that means. Now there are yield generating tokenized assets, and then there are non-yield generating tokenized assets. A stablecoin is a tokenized asset that doesn't generate any yield. It basically works like the United States dollar or any other currency. And a currency, by simply holding the currency, you don't get any yield. Like like if you have $100 in cash, it will remain $100 in cash for eternity. It suddenly doesn't like uh, give birth
Generate.
to like a $5 interest rate over the time. It doesn't. So that's what a stablecoin is. And if a stablecoin issuer starts giving you yield, it starts suspiciously
Behave like a
behaving
bank.
like a bank. And to be a bank in the United States, you have to have a bank charter, and that's a whole different game. So simply a stablecoin issuer is not allowed to issue any yields on that stablecoin. Now, what about any other asset that is tokenized? Any asset that was yield generating even before they were introduced to the blockchain will continue offering yield when they're on the blockchain. And
Mhm.
the only changes that takes place in that asset is how the asset behaves. Previously, you had to go through a myriad of centralized authorities getting approvals.
Right.
You have to trade in a certain time window. You have to pay a certain amount of transaction fees. With blockchain, all of that goes out of the window, and you get like instant settlement, extreme like a very high amount of liquidity access, and all of this stuff. So tokenization essentially means like the asset now lives on the blockchain. Now, what kind of assets are we talking about?
Mhm.
Let's take a look at that. Okay, so there's this website called rwa.xyz that tracks every kind of tokenized assets that we currently have available. The current RWA market is at $24 billion. RWA is real world assets. Real world assets is basically every kind of asset that isn't crypto. So it's a
Ah,
pretty lame name. I think we should
mm,
change it. But for now, RWA is what we call it. And right now, the market size is 24 billion. But what we are looking at it, like the way institutional investors and the governments are approaching it, this market is going to explode to trillions and trillions of dollars. Standard Chartered, I think they projected the market to cross $30 trillion by the end of 2035. So yeah,
Oh.
and basically the fun thing is it's not really creating any new markets. It's just all of the open market that we have currently, like the equity market back in 2023 or 2. They calculated the equity market size to be at $140 trillion. That is the
Mm.
size of the equity market that is currently using traditional finance technologies. And all we have to do is move that market to the blockchain. And now we
Blockchain.
have a $140 trillion market that
Uh,
that operates in blockchain. So the general asset classes will most used asset on the blockchain in the RWA world is obviously stable
Stable
coins
coins.
with a market cap of $240 billion, right?
Mm-hmm.
And then after that we have US Treasuries. Now we have already gone through all of this, like what a US Treasury exactly is. US Treasury is it's United States government's debt. They are issuing debt. We are buying it
Was
because we
giving out
believe,
to the government.
yes, it's basically guaranteed amount of yield. Right
Mm.
now, the average yield to maturity is 4.13%. Yield to maturity means like every United States Treasury, be it a bill, a note, or a bond, every single one of them has a maturity. Like if it's a bill, then the maximum maturity period
Less
is
than
2 years. Yeah, if it's a note, then it's 10 years. If it's a bond, it's 30 years. Now, till it matures, and by maturing, it means like you receive the money that you paid for, but till it matures, you periodically earn this. This is the yearly yield that you get. Like
interest.
this is the interest that you earn on the asset that you have bought. Now, what's the difference between US Treasuries on the blockchain and US Treasuries on the traditional finance world?
Mm.
Nothing. It's the same thing. It's just some companies that have bought a shit ton of physical traditional finance treasuries through the conventional system, and then they have brought it on blockchain and introduced it to the blockchain world. So, for example, the biggest one that has done this is the Biddle Fund. At the
BlackRock.
very top. Yes, it's BlackRock's Biddle Fund that has like $2 billion of US treasuries. Then you have got so for example, you have got Ondu, Franklin Templeton, Centrifuge, Circle. These are all people who have bought the treasuries from
Treasury
there
bill
traditionally, and then they have brought it on the blockchain,
of the
and they have
blockchain.
issued it, and you can now buy it on blockchain using stable coins. That's the fun. That's what's fun about it. Like all of these investments now, you can use stable coins to buy US Treasury. Like if you don't want to buy US Treasury, if you want to buy like global bonds, you can do that as well. You can buy European bonds
Uh,
from like backed finance from Spico. Again, like you are using stable coins to buy these things on blockchain. You never have to interact with any other like Web2 interface ever. Everything is on the blockchain now. Private credit, the same thing. Like what private credit is, let's not get into the specific details. It's basically like private credit is when one company lends to another company without going through a bank.
I see.
Why? Like many reasons. Let's not go into that. But yeah, private credit is another a lucrative option for tokenization. Then we have got commodities. Commodities means it's your gold, your silver, your any kind of precious metal.
Mm.
Then it's your agricultural stuff, minerals, anything. Anything that has the financial value, it's traded. And anything that has the financial value is a financial asset that can be introduced, can be brought on chain, and that's exactly what Paxos Tether they do. Then you have got institutional funds, pretty similar things. This will be your venture capital, hedge funds, private equity, um, and then at the very end you have stocks. Now, stocks is the fun thing. So, for example, like if you want to buy Apple stocks, you have to go through like an US exchange, or even like an Indian exchange that allows you to trade with the Nasdaq stock exchange, right? So, what if you like there is no other option, but with tokenized stocks, you can invest in Apple stock or any other stock
Like it
directly on,
reduces the
on
bar,
blockchain.
right? There's no gatekeeping.
Yeah, exactly. There is no great gatekeeping. Someone owns the physical stock, and now they're issuing it on blockchain. And very soon, what will happen is Like these companies will start issuing stocks directly on chain. Like for example, Nasdaq or New York Stock Exchange will start issuing their stocks directly on chain, and you can buy it on with stable coins. And that's exactly the promise of stable coins here, is that stablecoin will become the de facto currency form. What do you think?
Yeah, it's pretty interesting because as a layman, the first question in my mind, as per whatever you have said, is why isn't people like sort of doing everything in stable coins? Because it seems to be faster. There's no
Yes.
paperwork. There is no global sort of this gate that someone from other country can't access it, or someone with lower, like let's say someone can even buy ownership for $10, let's say
Hmm.
for a real estate property, but with tokenization you can do that, whereas if you are without it you can't. So it like democratizes the whole thing. There's this one line I heard today that technology is a great democratizer, and I think this just shows in this whole concept.
Yeah, yeah, exactly. And and the concept of fractionalization that you're talking about, it's very interesting. Is because basically like, okay, let's take real estate for example, right? So a real estate construction project worth, let's say $100 million, and you want to own a piece of it, but you obviously as a retail investor you don't have access
Don't
to
have the money.
any kind of like any amount of around that figure. So what you want to do is if the construction company or whatever bank that is backing it, if they let you invest on chain and they fractionalize that in that amount, then like even you can pitch in with $10 or with $100 or $1,000, and you will have exposure to it, right? Like one of the great examples of this, and this is something that I am actually actively working with in crypto, is there's this company called Livart. I'm an active member of that company, and what we are doing there is we make it easy for people who for retail investors who can buy, who wants to diversify their portfolio by accessing alternative assets like art, like luxury cars. Like there are watches like Rolexes and old Rolexes and stuff like that that appreciates in value. But obviously the barrier to entry there is so high. Like you'd have to have thousands and thousands of dollars to buy something like that. So what Livert does is they buy the physical asset, tokenize it, and then fractionalize it. So like for a fraction of the amount, you can own a piece of a painting by Andy Warhol. And then you get to you basically do whatever you want to do with it. You can sell it, you can trade it, you keep it in your collection, and it will always be there. That's actually the fun thing of tokenizing it, because of the fractionalization side of it. And like for so long, these big ticket assets have been stuck, trapped,
Right.
maliciously restricted from the retail investors, because the retail investors are not going with millions of dollars. They have a few $1,000s that they want to invest. And when you create this, when you make these asset classes accessible, you are attracting billions of dollars, not from like one entity, but thousands of retail investors, and that increases the liquidity of the for these assets as well. That is the fun of fractionalization, basically. So, what do you think?
Yeah, it's pretty interesting that it's the same thing that technology is a great democratizer. And the point that I found the most interesting in whatever you said now is that it will indeed attract more money than if just one person with that has only, let's say, $100 million, versus when it lowers the barrier to entry so much, then there can be more number of people with a lesser amount of money. But when you combine, it's like more than $100 million. It just brings in more money.
Yeah, yeah, exactly. All right, man. This has been super fun.
Exactly.
Yeah, let's.
I think the more deeper we are going, I'm finding it more and more interesting. I'm finding this episode more interesting than the last one. The first one, it was not that interesting because I was my mind was so blank. It was all of it was very new, but slowly and slowly, I'm trying to getting in the hang of it.
Yeah, yeah, absolutely. And uh, the more you learn about it, the more obvious it becomes. Like,
Yeah,
why do
exactly.
we don't we already have this in place, right? And yeah,
That's a very good way to put it because that's exactly what is happening with me.
yeah, exactly. So, what are the things that are stopping us? Obviously, like trust. People's trust is a major thing, and crypto has been only around since 2008. Not even crypto, like Bitcoin has been around since 2008. Ethereum came around in 2014, 2015, and since then everything else has come around. So you need to have time in the market. You need to prove the asset class has to prove its ability to perform consistently year after year. Like the stock market goes up year after year. Has been doing it for the last 300-400 years since the first stock exchange in Amsterdam was established. So the market trusts it. The market trusts real estate. The market trusts gold. Does the market, because all of these have hundreds of years of history. But does the market trust crypto? It has started trusting crypto in the recent
Just
times
saw
with
the
more.
report, right?
Yeah, exactly. And now, so since the government is saying that more and more people are open to the idea of investing in crypto or crypto related assets, now they're creating regulations to make it easy and make it safe at the same time, so that these billions of dollars are safe and are being invested productively. So the more regulation we have, the more open the market will be in due time. Like in the next 10 years, we are going to see a fundamental change of how we approach the financial market. Everything will be accessible to everyone at every corner of the world. As long as you have access to the internet, you can access any financial market. Okay. On that cheering note, let's end it for today. We'll see you next week. Bye bye. Ciao.
Ciao.